The purpose of this video is to discuss everyone's favorite topic. Yep, you guessed it, it's tax planning. And specifically what I'll discuss are a few high-level principles which are important to keep in mind when thinking about your taxes. Before getting into specific principles, I feel it's important to discuss why you should care about tax planning and why it's so important. I often discuss the importance of efficient planning, and at its core, efficient financial and retirement planning means you're making the most of your given resources. You're maximizing the usage of them to achieve your goals. For example, for retirees, you may be eligible for a pension. You have your Social Security income, your savings and investment accounts, and efficiency refers to utilizing them as best as possible in a coordinated and cohesive manner to achieve your goals. Unquestionably, the biggest opportunity I find for improving the efficiency of plans is through good tax planning. That is, paying as little tax as possible under the law. Tax efficiency is a critical part of having an overall efficient financial or retirement plan. And the actual savings over time resulting from tax planning is often measured in the hundreds of thousands of dollars. So there's significant opportunity here. And the opportunity isn't just limited to people with high incomes, high net worths, or with multi-million-dollar investment portfolios. Everyone can benefit from good tax planning. This graphic at the bottom from Carl Richards of the Behavior Gap does a great job of illustrating the value of tax planning. Why pay more taxes than you have to? Engage in a professional with tax planning expertise to help you improve the efficiency of your overall financial plan. Now let's dig into the key principles of tax planning, starting with the most important one. So principle number one is the objective of tax planning is to minimize your total taxes over the long term. The goal is not minimizing taxes in any one given year or just for a few years. So when performing tax planning, it's important to look out into the future and plan for the long term. This is oftentimes measured in decades, such as with a potential 20, 30, or more year retirement plan. And paying taxes, or paying no taxes, I should say, or very little taxes in any given year may make you feel great in that moment, but almost always it's a result of just looking at the current year and not looking far enough out into the future. For retirees, for example, these low income years are often years when you first retire or transition into part-time work before you started your Social Security or your pensions or being subject to RMDs. And once these years pass, you can't go back in time and get them back. Low tax brackets are a terrible thing to waste. The goal is to pay taxes when the rate is the lowest. To the extent that you can control the timing and the amount of income and the associated taxation of it, you want to pay the tax when the rate is the lowest. Things like Roth conversions or saving in pre-tax or Roth 401ks, charitable contributions. These are all levers or strategies which may enable you to control the timing of when income is taxed. So, two critically important factors. One, tax planning requires forward-looking long-term planning, and two, again, the goal is to pay taxes when the rate is the lowest. Principle number two regarding taxes is there is no such thing as permanent. Permanent does not exist. There's basically two general categories of tax laws. The first is rules that we know that they're scheduled to and when they're scheduled to change. And the second category is rules that are not scheduled to change and they're written as quote unquote permanent, but permanent means until Congress decides to change it. There's a saying in tax planning, and it's so true, is that the tax code is written in pencil, not in ink. And we're experiencing that right now. A great example of that with the TCJA, which was passed in 2017, as the picture or diagram on the right-hand side shows, the current tax rates are there in green. So this law, the TCJA, is set to sunset at the end of 2025. So beginning in the year 2026, the tax rates will automatically go back up to where they were before the TCJA was passed. So those rates are indicated in red there. So the takeaway here is to realize that the tax laws are subject to change and future unknowns, but you must perform planning, tax planning, based on the current knowns and also stay abreast of the ever evolving rules. Tax and planning strategies which are appropriate today may not be appropriate or optimal tomorrow as these tax laws change via sunsets or Congress making changes to them. And that must be the lens through which tax planning is done. Principle number 3 of tax planning is that the tax rate does not always equal your tax bracket. And what's meant by this is there's numerous occasions where you may be in a lower tax bracket, but you have a higher tax rate, or conversely, you may be in a higher tax bracket, but have a lower true tax rate at different points in your life. Now you may say, how is that possible? And it's possible through a number of different things. And the primary one is being there's different credits and deductions at different levels of income that can be phased out and even eliminated once your income rises above certain thresholds. Additionally, new taxes can appear as you add additional income in. And these are oftentimes what's referred to as tax torpedoes. A good example of this is regarding Social Security for retirees. So Social Security can be taxed at zero, no Social Security tax at certain very, very low levels of income. But once your income rises above a certain threshold, 85% of Social Security can be taxed. So for example, someone who's in the 22% tax bracket, if they were to take withdraw another say $1 out of their IRA, that dollar would be taxed, but it also would trigger, in this case, 85 cents of additional Social Security income. So that $1.85 just from that $1 pull from the IRA results in $1.85 to be taxed at 22%. That's an effective tax rate of 40.7%. Again, very different than their tax bracket, which is 22%. Now again, this is somewhat of an egregious example of how your tax bracket does not equal necessarily your effective tax rate. And the takeaway for this is it's very important to work with a professional who understands these tax torpedoes, where they are, and is able to do planning around them so that you can be aware of them and plan around them and try to mitigate them as much as possible. Principle number 4 is that tax diversification is a useful byproduct of the choices that you make, but in and of itself, it should not be a goal of tax planning. Again, don't forget principle number 1. The primary goal that you should be striving for is to pay tax when the rate is the lowest. So sometimes as a result of doing that, you get tax diversification. That is, your investment accounts are spread across tax deferred accounts, tax free accounts, as well as maybe taxable accounts. But that again sometimes results from good tax planning and sometimes it doesn't result from good tax planning. And it should not be pursued in and of itself as a goal. Now certainly if you have diversification, tax diversification across your accounts, you should absolutely use it to the fullest, and it does provide you flexibility as it relates to tax planning. But again, tax diversification is a byproduct, not a goal of tax planning. So I thought it would be valuable to bring a few of these principles together in a real-life case study. So in this example, we've got a 64 and 62-year-old couple that's filing their taxes, married filing jointly. They retired mid-2022, so they have some earned income from wages during that year. They haven't yet started Social Security, and they're not subject to RMDs yet, required minimum distributions, which start at age 72. Their investment portfolio consists of $2 million in pre-tax investments, so 401ks or traditional IRAs, and they have another $200,000 in their taxable investment accounts. So this is a picture of what their baseline income projection looks like in retirement. You see across the horizontal axis is their ages, 64 all the way up into the early 90s. And the dark blue colored area denotes their projected taxable income. And then along these lines here, you see these are the different tax brackets. So the lowest one, the blue one, is the 10% bracket, the green one's the 12-15% bracket, then the 22-25, and then the top is the 24-28% tax bracket. So now if they followed a normal or a traditional distribution pattern from their retirement accounts, early in their retirement, they may draw from their taxable investment accounts. So they're living life large. They're so happy here, as I mentioned earlier, in their first years of retirement, they're down in the low tax brackets, right? They're down in the 12% tax bracket, bragging about how little tax they're paying. But without doing long-term planning, that's all good and well. They're happy there, but then you see over time, once Social Security starts and once they're required to take their required minimum distributions at age 72, their taxable income rises significantly to where over time, in their late 70s, you see they actually cross over and they're forced into the 33% tax bracket. So again, this is a couple who didn't do long-term planning and is one of those that may be bragging earlier on in their retirement at how little tax they're paying, but over time they're going to regret that because they're going to be forced to be paying ultimately taxes from their IRA withdrawals at a 33% tax rate, and they would have foregone or lost these lower tax brackets earlier in retirement. Now, what this client can and should do is, with a little bit of long-term tax planning, looking at this from a long-term perspective, again, the goal being to pay tax when the tax rate is the lowest, is to take the income that they would have deferred to the later years in retirement and move that up and actually pay that tax now when the rates are lower due to the current law, the TCJA, right, with those lower rates that are going to expire in 2025. Take advantage of those lower rates today. Perform Roth conversions, perform just distributions from the 401k, the pre-tax money in the IRA. Get that money out, whether it's through withdrawals or a combination of withdrawals and Roth conversions. Pay tax on that now, and then you can see what this does is move their income significantly down into future years, right? So where they're not crossing over into that 33% tax bracket at this point now. They're well down into that lower bracket, and they have a lot more flexibility with what they can do with this. This is a much more efficient tax efficient plan than what they would have done under that previous scenario. This diagram overlays the projected taxes on those two different plan approaches that we just illustrated. The projected tax savings on the second one, the one in green here, where we shifted the income, the taxable income earlier on, we moved it earlier to earlier years and paid the tax when the rate was lower. The tax savings, as you can see on the right hand side, are almost $430,000 over the planning horizon. That is the example of tax efficiency at work. We're saving this client hundreds of thousands of dollars, money that otherwise would have been inefficiently leaked out of their plan and been paid to Uncle Sam unnecessarily. And while the savings in this particular example may be on the higher end of what most folks may realize, it's a very common result of good tax planning, especially for people leading up to and transitioning into retirement. So performing long-term tax efficient planning, that is identifying opportunities to pay tax when the rate is the lowest. I can't recall a plan that I've worked on where there hasn't been significant value added, real term value add bottom line dollars from performing long-term tax planning. That's true savings to the client for the tax planning alone, without even considering other components of the retirement or investment plan like investment management or other such strategies. So thank you all for watching, and reach out if you're interested in assessing how you might be able to benefit from performing some long-term tax efficient planning. Thanks again. Have a great day.